Okay, hello. What's going on, everybody? Let me know if you can hear me loud and clear in the YouTube world. Sorry about the lighting in my room right now. It's super bright on the camera, but it's okay. How's everybody doing today? This fine Tuesday evening in Canada, but depending where you are in the world, maybe the morning, maybe the night, maybe the afternoon. Okay, welcome to a Capital Hungry Market Update and Trade Ideas webinar. Through this webinar, I will be giving some fundamental and technical analysis on gold, GBPJPY, GBPUSD, EURUSD, USDCAD, US30 Stock Market Index, as well as looking at what current fundamentals are impacting the market, what economic events we have on the table, and of course marking out some trade ideas. Okay, so everybody can hear me. I might as well just jump right into the meat and potatoes. Everybody's hungry for the information, so let's jump right into it. So, recent fundamental points. As we've been starting out the new business month period, we've had lower volume and volatility. We're still primarily having a lot of pullbacks in correction phases of the higher time frame trend across the board, which was explained in the last free market update webinar as well. A lot of the various central bank monetary policy sentiment information so far has been priced in, and we have been starting to get some new signals of more rate actions to be taken by the central banks in the near term. So keep in mind lower volume and volatility as we're starting out the new business month, and a lot of the previous fundamentals such as Federal Reserve rate hikes and minor geopolitical tensions have been priced in. And majority of our trading instruments and asset classes that we trade, such as gold, US stock market, dollar individually, or dollar pairs, majority of them are in corrective phases of market structure, either consolidating or pulling back against higher time frame trend. We do have some geopolitical tension starting to rise with Taiwan and the uncertainty developing with China invading Taiwan, but all of that so far is just noise. Taiwan tensions are not having any major impact to the markets as Japanese yen is still relatively soft. Yes, gold is seeing some short-term upside and can still sneak up into the 1800s as I've described to you in multiple webinars, but below the 1800s, roughly 1810 area on the higher time frame is still a major sell side liquidity zone and retest of bearish market structure, as well as understanding the macro information advantage of central banks in their monetary policy positioning is still holding the most weight. So the Fed giving signals at more rate hikes to come for September meeting and the market starting to price that in is still holding weight and keeping dollar higher time frame bullish and keeping gold below the 1800s, as well as maintaining our higher time frame structure on dollar correlated pairs. In terms of sentiment, the higher time frame on US dollar is still very bullish, even though we're having some minor intraday ranging. And dollar, when you're looking at the dollar index individually, would need to be trading well below 105 to be signaling any more bears or short orders in the market and any more weakness in the Federal Reserve sentiment of more rate hikes to come. Japanese yen individually is still very bearish as the Bank of Japan continues to initiate their unlimited bond buying program and keeping interest rates in the negative, which is keeping the Japanese yen individually bearish. Stock markets, even though they're having the short-term bear market rally and upside, we do have to keep in mind as we're approaching some key sell-side liquidity zones. But global equity regions are just having a bear market rally and short-term upside from the last previous significant dips created. We do want to keep in mind with what we've seen to start out the new week, as the NFP information and labor market data from last week was priced in, as a lot of the Taiwan headlines are having minimal impact and primarily just noise, as we're still starting out the new fresh business month. Volume and volatility across major trading pairs that we trade has been relatively slow and low. So we do want to keep that in mind as we have to stay adaptive to the market conditions as manual retail traders. Some key news headlines that we've had coming up is just President Biden signing the CHIPS Act to boost US semiconductor manufacturing and compete with China. Some more instigations in pushing the bear that is China. Pelosi also pushing the buttons of China, talking about how they can't allow the Chinese government to isolate Taiwan. And we can also see more rate hike expectations from the Bank of England following suit with the Federal Reserve, as we've already had a lot of Fed parrots, aka Fed speakers, signaling at an expected 50 basis point rate hike, with even potential of a 75 basis point rate hike for the September FOMC, as the labor market is still robust and US inflation is still very high. In terms of economic events, we're primarily focusing on inflation figures through the London session as well as New York tomorrow. Now, we have to understand something, and I'm going to be giving you guys an educational breakdown on the current economic climate of inflation and what to expect with the inflation report tomorrow. All right? Are you guys in the chat ready to pay attention? Let me know in the chat if you're ready to pay attention. You might have to listen to this a couple of times. You might have to go do some back testing and review it again. But the inflation report tomorrow is going to be very, very interesting. A lot of people expect that if inflation is still very high and is still in this record high ranges and better and higher than the forecast, a lot of people are expecting gold to go up bullish. Inflation is high, gold is an inflation hedge, and you have gold push up with high inflation and more buy side liquidity coming into it. In normal conditions, prior to the Federal Reserve's rate hike cycle, this would be true, right? Before the Fed was actively raising interest rates, before they started their tapering and rate hike cycle, as we were having the pandemic take place, majority of high inflation readings would lead to short-term dollar weakness and would lead to gold pushing up bullish as an inflation risk hedge, right? But what we have to understand is this situation and scenario is different. These high inflation reading reports are coming out the same time we have an active rate hike cycle by the Federal Reserve. If the inflation reading is high, you might see gold push up in the short term, right? Even me, when I'm looking at gold higher time frame structure, right? I even have a sell limit here at around 1805, right? Because I'm expecting that even if the inflation report is a high reading, we might get an upside move to here, retest those previous higher time frame lows and bearish market structure, and I drop down my risk in terms of the stop loss. But if we don't break well back above the 1805s, and we understand the integrity of bearish market structure, let me show you guys what I'm expecting, right? Normally, a high inflation reading would lead to upside on gold. But look at here in the yellow box. This was the last high inflation reading here. You can see in the short term, it led to gold pushing up, but overall still had gold bears come into play for a very, very specific reason. Does anybody know why the last inflation report had gold push up but turn right bearish again going down to 1680? Quick pop quiz. Don't worry, we got time. Anybody in the chat? Why, even though the last inflation reading here was very high, why did gold still end up pushing up in the short term, but then turning bearish overall? Because the high inflation reading signals to the market and signals also to the Feds that they need to be more aggressive with rate hikes. So all this inflation reading did was signal that there's a higher probability of increased rate hikes to come. What is the impact of higher US interest rates on gold? I'm gonna be your guys' I'm gonna be your guys' economic professor for the YouTube audience, right? Bearish. So tomorrow, what I'm potentially expecting is if the inflation reading is still high, we might see one more leg up or an impulsive buy side move into the 1805s, into the 1810s region, but very similar to this last inflation reading or any of these other poor economic data reports or priced in inflation reports, right? But if we do not break above this price sensitivity area, if we do not break back above this previous sell side liquidity zone in previous lows, as well as potential retest of bearish market structure, what that inflation reading is going to do is just push price up to a better sell side liquidity zone for short orders to be collected and lead to downside either in the next daily candle or hours that follow, because a high inflation reading will just signal that the Feds need to raise rates even more aggressively. Does that make sense for everybody? Is everybody following along? Right? Even though if you guys have been following along the market updates or the people in Capital Hungry have been following along our trade ideas, for the last, since the end of July, start of August, we've been playing this gold upside, and that's been perfectly fine. We haven't been playing this gold upside for any major fundamental reason except a priced in FOMC, sellers liquidating positions at a 1680s monthly institutional demand zone, and simply having a pullback phase occurs. It's the same time you had sellers print a low here in a pullback phase, sellers print a low here in a pullback phase. The way gold behaves, it is very, very common to see aggressive pullback in corrective phases. These pullback in corrective phases, which can last months long and can be hundreds to thousands of pips in overall size, right? But regardless, have any of these pullback phases, even though they've been aggressive, have any of these pullback phases broken macro bearish market structure? No, right? Even though gold can enter these very, very aggressive pullback phases, none of these pullbacks that all come from new higher time frame lows that have been printed, none of them have broken this higher time frame structure or back above major zones yet. Here, this pullback never broke back above the 1900s. Here, this pullback never broke back above 2000. Here, this pullback never broke above 1800 yet. Very, very significant price points in sell side liquidity zones that get respected from an institutional perspective. Isn't that very interesting? Is everybody following along? Right? The same time that we have gold in a pullback from new lows being printed, as the FOMC, last FOMC was priced in, and we had short-term weaker economic data, as well as Taiwan tension starting to bubble on the table, this is the same time dollar individually has been in pullback structure from its highs, right? The same time GBPUSD has been a pullback from its lows. EURUSD has been in a pullback from its lows. But has any of these pullbacks, whether you're looking at your dollar pairs like EURUSD, whether you're looking at GBPUSD in its overall bearish structure, whether you're looking at dollar index in its higher time frame bullish structure in inverse and buyers consistently printing higher highs, has the higher time frame structure across the board been broken yet? No, right? We can't expect any further higher time frame gold upside unless we have a fundamental catalyst and trading well above the 1800s. Right? The same type of catalyst we would need to hold above the 1800s would also be more correlated to our other trading instruments as well, but just understanding we have different impacting factors. So what could this be? Maybe if Taiwan actually gets invaded. If China actively starts to invade Taiwan, that would bring new fear, uncertainty, and doubt. That would be a reason for safe havens to pick up strength. That would be a reason for gold to break above and hold above the 1800s and start shifting into higher time frame structure. Does that make sense to everybody or no? But we have to understand, China is not as aggressive as Russia. The China-Taiwan tensions are not the exact same as the Russia and Ukraine tensions or that invasion. China is very well known for playing the long-term game, for playing the slow game, for not instigating or impacting their international business or affairs, but probably taking over Taiwan from a long-term economic front. And you just have this tension that the US and these other countries are building up. Just like the US and the Western propaganda built up the same tensions with Ukraine and Russia. But unless China actually starts to invade Taiwan, what we can see is all of the upside we've had so far is fairly regular and is fairly normal in line with gold bullish pullback structure, not showing us any higher time frame buyer bias. Let me give you guys a great comparison example, right? Let's look at this. So overall, let me break this down for you. Gold has been bearish for this reason highlighted in red. Fed rate hike cycle. Okay? As the Feds have been giving consistent signals of rate hikes to come over the last year, this has been the main fundamental catalyst after this Russia and Ukraine tensions were priced in, where you have these impulsive, aggressive downside moves that go to print significant lower lows. Right? This is the main reason for this. You can see the upside we've had from significant lows, whether it's here or here, it doesn't matter. Even though we're having China-Taiwan tensions and noise in the media, the price action and structure we're seeing on this run from the low to revisit bearish structure is no different from this and is no different from this, right? Let me show you an example of what high volatility invasion price action would look like. This is bearish market structure and Fed rate hike cycle being the macro information advantage and the main driving factor that's been leading to stock market bears over the last year, dollar bulls over the last year and a half, and gold bears ever since we peaked 2075. This is the price action, this is the structure. Take a quick visual snapshot of this, right? This aggressive bullish movement here, this was Russia and Ukraine. When Ukraine started to get actively invaded, when you had huge bullish upside moves, very clean bullish structure. Do you understand what I'm saying? Now, when we bring that together in comparison, and we can fit this on the screen, look at the difference in price action, volume, and volatility from the Russia and Ukraine tensions versus just this gold pullback we've had from these lows so far. Does that make sense for everybody? It's a completely night and day difference when you're looking at this scenario of pullback bulls and you're looking at higher time frame geopolitical tension driven bulls with a country actively being invaded. Huge bullish moves, huge upside plays and pullbacks, continuation upside for multiple days. Does that make sense to everybody? If we were to have Taiwan get actively invaded, we would see this type of market structure, but above the 1800s. Is everybody following along or no? If we don't get any active invasion of Taiwan, if we do not get any active invasion of Taiwan, if we do not get this type of price action forming above the bearish market structure, if we don't have any reason for new fear, uncertainty, and doubt, overall, what you're going to have take place is more rate hike signals, maybe sweep the high 1800s and start to turn back bearish, playing this overall structure that has yet to be broken over the last year. Is everybody following along? Does that make sense to everyone? So let's summarize right now. The inflation report tomorrow, everybody's expecting that if inflation is very high, it's going to lead to gold upside. In my opinion, it will lead to gold upside, but being very short-lived, and then potentially seeing sellers jump back in the market from better sell-side liquidity zones. Now that I'm looking at it, I'm actually going to move my sell limit to 1810, just to make it a bit safer in case we have an aggressive upside play. My screen froze. Move this bitch. Okay, so I moved my sell limit to 1810. I'm gonna move it in 3 more minutes. I thought it was already 6 p.m. But I'm gonna move that in 3 more minutes to yeah, you guys like that withdrawal? I withdrew 50K this month after making almost 300K over the last few months on my big account. But as soon as the markets open at 6 p.m., I'm going to move this sell limit to like 1810, 1812. But anyways, what I'm expecting is the inflation data. Oh, you guys can't see, my camera's in the way. What I'm expecting is if the inflation reading is high, yes, it will have a short-term upside move on gold, but I expect it to be very similar to the last inflation move. This was the last inflation reading here, right? Overall bears due to more rate hike signals. Now, if we see something like that as well as here, as we're digging into that sell side liquidity zone I'm telling you guys about, right? If we see that we have a very, very high CPI reading, we can see some short-term upside on gold. If CPI very high, above forecast, short-term upside on gold, retest higher time frame sell zones in the 1810s area, but that high inflation is going to signal more rate hikes to come, leading to gold bears coming back into play from retesting that area. Or if we just have a low inflation reading and then our higher time frame buys coming back into play on the dollar, right? I want to show you guys this example. This was the inflation reading on July 12th, 13th there, right? Yes, Mr. Pear, if the inflation reading is lower, I'm just expecting gold to drop, maybe just have a quick drop in range still. Correct. Good thinking, sir. Yes, sir. Now look, this right here was that last CPI report into July here, the same type of idea. Right? You can see, even though the inflation was very high for the US economy, in normal conditions, that would lead to dollar weakness. But it led to dollar just having a short-term spike to the downside, collecting more buy-side liquidity and continuing even more bullish. What I can expect is actually a similar sequence of events. Look at what we have happening here and look at what we have happening here. You can see we're still having dollar very, very bullish above 105 price point here, right? We're still having buyers have a pullback from these new highs printed by buyers here. If the inflation reading is very high, that can lead to a short-term spike down on the dollar, retest these previous highs in demand zone, and then continue bullish in the next hours or the next day as it signals more rate hikes to come by the Fed. If inflation is just low and showing improvements, dollar should just go up instantly. Does that make sense to everybody? This move correlated on gold. The correlation isn't between dollar and gold. The correlation is between dollar and the federal. The correlations between dollar and the economic data, as well as central bank actions by the Fed, and gold in the same impact it would have there. Except on gold, Instead of seeing this downside move, and then you continue back up bullish, right? No, I trade live. It's a live account. It's not. I can check my client portal if you want. It's a live account. I've been trading live for like almost 4 to 5 years now. Someone's just mad at the profit I made 5 years later. It's okay. It's okay to be a hater, Mickey. The Dominion account is a live account, but the trades are not sent to the market. In reality, it's a demo account in the name of real. No, it's not. It's just a live account, like everybody else has to sign up to the broker and set up a live account. This one, this is it. This is the account. Okay, so now let's understand and bring all that information together for our analysis across these pairs. Okay, we have at 2 a.m. Eastern, we have German CPI, which is still expected to be relatively high, won't have too much impact. From 2 a.m. Eastern, 4 a.m. Eastern, 8:30 a.m. Eastern is just all of our inflation figures, okay? Italy's inflation figures at 4 a.m. Eastern won't have too much impact at all. The main meat and potatoes that we're looking for is this CPI report. To give the example of this CPI report and the impact I'm expecting on gold and the dollar, if the inflation reading is very high and above forecast, I'm expecting a liquidity grab down on the dollar and then continuation up, or just continued bulls above 107 if inflation is low. Next hours or day as increases probability of more rate hikes. Inflation improvements and low, dollar should just go up. Oh, you guys can't see because my, let me move this quickly. So you guys see that on the dollar? All right. Now, understanding that on the dollar, it's the inverse there on gold. When we're looking at gold here, obviously we have this higher time frame structure being respected. No, inflation being high doesn't always signal more Fed rate hikes. You have to understand the current fundamentals in play. How long have I been trading? For about 5 to 6 years coming up now. Okay, so if the inflation report is still high, I can see a pretty aggressive upside squeeze into the 1810s and then turning back bearish again hours or the next daily period after. If inflation is low and showing improvements, I would just see a drop below the 1780s on gold, respecting the bearish structure as dollar buyers would come back into the scene, and low improved inflation would have no reason for gold really seeing any actual upside, and more rate hikes are still inevitable. Does that make sense for everybody? And we're going to zoom in even more to break that down now. So I could possibly see something like this. And this is the example. Obviously, the US CPI is like a full day away still, right? Well, not a day away, but it's still hours away. We still have the Asian session. We still have the London session to come and so forth, right? But talking about if it was from current price points of interest, if it, let's just say right now we have the CPI report coming out and it's a very high CPI report, we might see an impulsive move to the upside, and then after rejecting into the 1800s, that move get faded out with more signals of increased probability of rate hikes. Or if inflation is just low and improved, does that make sense to everybody? Even in terms of the regular general trade ideas, I would still see the potential upside into the 1812s over the Asian session, London session, and into New York hours, and potential higher time frame sells in these areas, right? I can only see any further extended gold upside above 1812s with new fear, uncertainty, and doubt. Does that make sense for everyone? So in terms of gold trade ideas, I would still see short-term upside into the 1810s and potential sells at that higher time frame sell side liquidity zone, or safer sells coming back below 1780s, 1781 area. Oh shit, the video box is in the way. Sorry about that. Just saying that for here, I would need new fear, uncertainty, and doubt, such as Taiwan actually getting invaded, to be holding above the 1810s. Okay? Now, bringing that information together on GBPUSD and our other dollar pairs, I can see with the CPI data, if we have short-term dollar weakness, potential pullbacks to these better sell side liquidity zones before still continuing with the higher time frame bearish trend. Still playing higher time frame dollar bulls, higher time frame bearish structure on GBPUSD, potential double top in this area in sells with a CPI price grab, and turning more bearish with the higher CPI, just leading to an increased probability of more September rate hikes. I can only see any further buys on GBPUSD if we safely break above 1.23, have dollar weakness on the higher time frame as well. Okay? Hello, Mr. Adam Kins. You're an economist? Very nice to meet you, Mr. Economist. Thank you. So yeah, GBPUSD, red boxes sell zones on the intraday time frames. I would only be buying at this point above 1.23. Euro USD. Higher time frame bearish structure still being respected. Still below this potential sell side liquidity zone and accumulation of sell orders in this consolidation. Even if we have a deeper price grab to the upside but come back below the range highs, would still be looking to jump into the higher time frame sell side bias as dollar is still strong. Euro individually has weaker data, and ECB's rate differential is pretty wide between the Feds and the Euro Central Bank, as they're just recently starting to come out of negative territory. And Euro USD overall price action is still bearish, and bearish market structure on the higher time frames as well. I can only shift out of this bias and look for any Euro USD buys with the dollar weakness and Euro optimism breaking above 1.034. Okay. USDCAD is just relatively ranging. I would treat this as a no trade zone just based on a lot of the indecision, increased volatility, a lot of up and downside moves getting canceled out, aggressive wicks and lower time frame movement as well. So I'm expecting only buys on UCAD above 298, rejection point in key level, or above 1.304 medium term zone, patiently waiting for those confirmations of dollar strength back into the table, especially if oil still stays relatively soft and takes away some strength out of the Canadian dollar, and we have that dollar domination come back into play as the world reserve currency. Okay. US30 stock market index. Overall, the stock market has been in a bear market, and the US economy has been in a recession ever since we peaked these all-time highs at the start of the year 2022. The stock market is the leading indicator of economic recession. And as soon as there's a heavy bear market on the stock market, you have to ask yourself why, when the stock market is just designed to go up unless there is a crisis and catalyst otherwise. The main reason for this downside on the stock market has been the Federal Reserve stopping its support for the economy, aka stopping making so much money for the investors, tapering off their stimulus support, starting to raise interest rates, the same time you have all-time high prices hit. The conditions that made investing into the stock market so favorable, like the Fed pumping up the market with their asset purchase program, very low interest rates, increasing inflation without the act of raising rates yet, all of those catalysts and reasons for stock market bulls have been shifted on its head now. Now you have all-time high prices, active Fed rate hike cycle, US economy entering a recession, and stimulus support being stopped and the asset purchase program being decreased, right? You can see when you're looking at the daily time frame, and even if you go to the NASDAQ or S&P 500 and you reference the 2008 financial crisis, the GFC, or the 2000, that bear market rallies are very, very common. What we have been seeing from these new lows printed is nothing but a short-term bear market rally. If we cannot break above this last significant sell side liquidity zone at the 33,500 area, where from this area we had buyers liquidate positions driving us into lower lows, then what we can expect is if we have continued exhaustion here and more Fed rate hike signals, that we can be having dollar domination come back to the table and starting to bring us back down into these lower lows again. Right? Does that make sense to everybody? So when I'm looking at the equity markets here, we're in a very, very key make or break area around 33,500 as my key sell side liquidity zone. I would see short-term buys above 33K, short-term buys above 33.2, but at that sell side liquidity zone to the left, if we start to see rejection, higher probability buyers will liquidate positions from these better price points of interest. And then you have dollar domination come back into the scene. VIX turn bullish as well, and rejection sells from there. Otherwise, just the safer sells below 32.4. Last but not least, GBPJPY. On the higher time frames, GBPJPY has been very bullish as the Bank of England is in an active rate hike cycle, and the Bank of Japan is still keeping interest rates in the negative and their unlimited bond buying program active. You can see very similar to the 2008 GFC financial crisis. I'm just here on the weekly time frame. We're having very similar technical repetition as well to see rallies going still heavy into the higher time frames of the 170s and potentially higher, right? Very similar repetition in terms of market structure when you have these short-term consolidation or pullback phases, which you're seeing here. And as long as we're still trading well above the 160s and Bank of Japan keeps their unlimited bond buying program going and Bank of England signals out more rate hikes to come, which they have no choice to do, there's a lot of potential for GJ upside still. Brexit tensions are well priced in. COVID and all the pandemic stuff is well priced in. We're actively following central bank sentiment holding the most weight, and the differential between Bank of Japan's rates still in the negative and Bank of England being a lot more hawkish, right? This is the main reason why dollar has been so bullish, is an active rate hike cycle by the Feds. And on the flip side, why the yen individually has been so bearish is that the Bank of Japan's doing the opposite. They're very dovish still. They're keeping interest rates in the negative as their economic situation is different compared to the US and has been different for a decade plus now, right? So even when we're zooming in further, you can see a lot of rejections here, still respecting some short-term bearish corrective structure, where once we're really trading above 164s, there's a lot of clean and steady upside to revisit these highs and potentially even continue higher. Does that make sense to everybody? In the intraday time frames, as we're zooming out, you can see we've had very strong respect with a lot of institutional buy orders being collected with the difference in the rate differential from this 160 zone. You can also see very similar reactions where you have aggressive snapbacks in price, short-lived bearish pullback phases to generate some more liquidity, and overall still continuations to the upside, especially if we start trading above 164s on the higher time frame. Right? So you can see on the intraday time frames though, as we're starting out the new business month, as a lot of the fundamentals from the previous month have been priced in, you can see a lot of intraday ranging here. What we would need for clean cut upside is trading above 163.5. But nonetheless, even in this range, retests of 162.5, breaks above 163.5, breaks above 163.8, would still be looking for upside plays and buys on GBPJPY. I would only be looking for any short-term sells below 162.2, where I'd still just expect deeper pullback plays to generate liquidity from better demanded price points of interest from an institutional perspective before continuing bullish again. Okay, everybody? So, first half of this webinar, I was telling you guys about macro higher time frame analysis, what has been holding the most weight, inflation expectations. We went through key fundamentals in focus. We went through understanding market sentiment analysis and what's impacting it. Recent notable news headlines of interest. a current volume reading just based on price action and some of the intraday ranges we're seeing, higher time frame and intraday analysis across pairs, and trade ideas shared across the pairs as well. You can rewatch this as you wish. It's going to be saved and uploaded, and I'll see all of you on Thursday for a New York scalping session at 7 a.m. Eastern. Hopefully you guys enjoy these webinars. You find them very educational, value-filled, and useful. Make sure to rewatch as you wish. Share it around in other trading communities and groups, and I'll see all of you later.